All right, welcome back, everybody, to episode 80 of the Volatility Barometer podcast. We are back pretty soon. We just did another one just a couple days ago, but there's actually a topic today that I really do want to get out there as well. As you know, the market's been very stable and calm for a while. We got that VIX index getting to pretty low levels, and right around now is the time that a lot of traders out there start to get antsy and perhaps maybe want to do something silly like being the contrarian and waste a bunch of money buying long options, right? They want to jump in there. They want to be the first person to make all their money. Well, today, as the conservative investor here, I just want to give my take on potentially a better way to go about doing this. So we've got a question coming in from a VTS subscriber, but to be honest, I'm getting several of these per week now, and so now is the time to actually answer this.
Welcome, you've got mail.
So our friend David M asks, with the VIX at such low levels, is now the time to start buying VIX calls? So I'm going to split up my answer here into two sections. First of all, we're going to see if the VIX actually is considered low right now. Let's actually analyze that initial premise. And then after that, I'm going to show you three option types that might actually be higher probability of success versus just straight up VIX calls. Trying to make a profit by buying calls either on the VIX or the UVXY, the VXX, it's actually a pretty low probability trade. So I'll give you a few ideas that might work out better for you. Okay, so right here we are looking at the VIX index going back all the way to 1990. Now, the VIX index right now, it's saying 1306, but since you said VIX call specifically, I'm going to assume you mean options trading on the VIX index. Remember, VIX options do actually settle to the VIX futures. So the front month VIX future right now is at 1455. So first of all, let's analyze that initial premise. Is the VIX actually low right now? So I'll rip through this pretty quickly, but the first thing that we can do when we talk about average is actually do the mean. The mean is just the average value in a series. So a basic example, 5 numbers, 3, 3, 4, 6, 9. I'm using them because they're very easy to add up. But for the mean, all you do is add up all 5, so it adds up to 25. And then you divide by how many values there were. So 25 divided by 5. The mean, or the average of this series, is 5. So with respect to the VIX index, if we do the same thing, if we just add up all of the values of the VIX since 1990 and divide by however many trading days that was, we actually end up with a long-term mean of 1958. Now, obviously, that's higher than where we are now in the 13 to 14 range. But what we have to remember is averages can be pulled up by those extreme levels. It's like income. If you look at just the straight up mean income, it's not very useful. We've got many mega millionaires and some billionaires who have hundreds of billions of dollars. That's obviously going to pull up the average. So what we could look at instead is called the median. The median is just the middle value in a series. So same numbers, 3, 3, 4, 6, 9. The middle number is that 4. So the median in this case is 4. Now with respect to the VIX index, if we just order rank the full distribution of VIX values since 1990, the dead center number is 1777. I would say this is a more useful number than the mean because at least in this case we can say that half the values were below 1777 and half the values were above 1777. But I don't think this is a really good representation either because of course this does include all market periods. But if you understand a little bit about volatility metrics, certainly if you follow the VTS community, it's actually not overly difficult to identify periods of relative market calm. So in this case, we might want to go a step further and talk about the mode. Now the mode is the most common value in a series. So again, 3, 3, 4, 6, 9, sequence them up. Of course, there's 2 3s. So the most frequently occurring value in this series is 3. We can do the same thing with the VIX. What I've done here is I have basically ordered all of the VIX values going back to 1990 into what's called handles. So a VIX of say 1350, that would be a 13 handle. A VIX of say 1225, that would be a 12 handle. So organizing them all, we can see that the most common one is actually between 12 and 13. The mode of the VIX is 1242. The second most common is a 13 handle between 13 and 14. I should mention down here I'm organizing them by 5. So you can imagine that this would drop off pretty quickly if I was doing just 1. So ignore this big number. There aren't actually that many over there. But most important is what's happening over here. Clearly, we can see that the VIX is very comfortable being in those low ranges between about 11 and 14. It's very common. So that's why the first thing I wanted to do is analyze your premise. Is the VIX actually low right now? Well, sure, it's lower than it has been recently, but if the market is calm, just remember that the VIX index values are very normally in the 11 to 14 range. Instead of using the word average, I would much more like to use the word normal. And a VIX of 13 is very normal. I would not say volatility is very low right now. So a more useful question in this case would be, how long do we think the market can stay stable for, and what should we be doing to potentially play for the VIX starting to go higher? One chart that I showed recently, but I can show it again. This is the longest S&P 500 streaks without even a 5% correction. So going back multiple decades, these are all the periods where the S&P 500 was very stable. We can see the current streak, we just cracked 100 days. It's not even close to the top 20 yet. We have to go another full month just to get into the top 20. And we've got miles to go before we start threatening the truly long streaks. We definitely want to keep in mind that while it does feel like lately the market is very calm, when you look at it through the lens of history, the stock market can stay calm for much longer than it already has. And remember, if that is the case, then the VIX index can also stay lower for much longer than people maybe realize. Where the VIX currently is right now, that by itself is not going to be an indication of when you should pile into VIX calls. Remember, in order for VIX calls to actually pay off, because it's such a directional trade, not only do you have to be right on the direction that it moves, but you also have to get the timing right as well. These are theta negative trades. They will bleed value the longer you are wrong. So even if the VIX does spike up maybe 2 months from now, well, if you're in VIX calls, the timing matters, and getting it early is actually the same thing as just getting it outright wrong. So now I want to go into the trading software and actually show you maybe 3 potential trades that would be a higher probability of success than just rolling the dice on those VIX calls, that actually getting the timing right is nearly impossible. So the first trade that I'm going to show you that I would consider a pretty decent trade, let's take a look at an iron condor on the VIX index. Now, I always like to give these trades a little bit of time. So let's say this May cycle right here. If we go out, I'm just going to show you what a basic iron condor looks like on the VIX index. So this is a very tight spot, but what I actually want to do is I want to show you an out of the money iron condor. So I'm going to adjust these, the put option to 18.15, 18.15, and then out of the money, you can go as far as you really want, but let's check out the 27 and the 30. This is an out-of-the-money iron condor on the VIX index. You can see the premium is $236, so one contract is basically $64. Essentially, the maximum loss for an iron condor is just the strike gap minus the premium you bring in. So the maximum loss in this case is $64. If we scale this thing to $1,000, let's say we go to something like 16 is probably close. Yeah, that's about right. So 16 contracts, you're risking about $1,000. And if the VIX just goes up a little bit, it's actually going to start to be in the good range. If it's anywhere from 18 to 27, you're talking about the potential for 3,776. You can see that down here. When I hover my mouse, you can see that turquoise number says 3776. This is a much higher probability of success, right? We don't actually need the VIX to skyrocket in order to make a profit. Now, if it does skyrocket, if it does go into the 30s or 40s, well, of course, you can just exit the trade and you're not going to be losing very much. But the point is, if you think the VIX is going to go up, it's a much better probability of success if you play for something that's a reasonable spike. I know everybody dreams of that moment where they're going to buy VIX calls and they're going to nail it perfectly, but that's just not the reality for trading. You actually want to be much more conservative. This is a trade that is obviously going to benefit if the VIX goes higher, but let's be realistic. We're not going to have to call this perfectly. Now, one thing that I will say, when you're trading complex options on any other underlying, like a stock or an index, typically you would be very worried about having in-the-money options, right? This is an out-of-the-money option spread where some of these strikes are going to already be in the money. But just remember, when you're dealing with the VIX index, this is a cash-settled index. You do not have to worry about early assignment. You can trade any strikes you want, and those contracts are yours until you decide to exit. So you can basically do whatever you want on the VIX. That is an advantage when it comes to complex option spreads. So that's our first trade, an iron condor. Let's look at another one. If you follow my work, this one will be actually quite familiar to you. But let's look at a broken wing butterfly. So first of all, standard butterfly, again, very narrow. We're going to have to adjust this. But if I say make this middle strike at 18, this one at 15, and this one at 21, this is actually a standard butterfly. Now, there's nothing wrong with this trade. You can see that this is risking $37, and if the VIX does go up near 18, well, it could make as much as 261. This is a good trade on its own. However, if we dip this 20 back down to 20, it becomes a broken wing butterfly. And now you can see what's happening is I transferred some of that risk from over here to this side. So we can still lose money if the VIX doesn't go up, but as long as it goes up a point or two, now it's going to be in that same nice profit range. But look at this side. You can see unlimited over here, no matter how high the VIX goes, you will also make money. Broken wing butterflies, you can choose the side of the trade that you want to put the risk on. And in this case, you said that you think the VIX is going to spike imminently here. So you can actually make it so the high side has no risk at all. Now let's scale this thing again. So we've got $46 for a maximum loss. What if we did 20? That gets us pretty close. 21 of them. That's about right. We could actually even push it to 22. So we're risking 1,012. If the VIX creeps up a little bit, you're talking about a potential maximum gain of about $5,400. Now you're not going to nail it perfectly, of course, but the point is there is actually a pretty big tent here of potential profit. And then if what happens, big massive VIX spike, well, you're still going to make almost $1,200 if that happens. You're not going to completely kick yourself that you missed the boat. Broken wing butterflies are a really high probability of success trade. You can structure this any way you want, and you can put the risk where you think is least likely. Again, in your case, you think VIX staying low is quite unlikely, so might as well dump all the risk over here, right? So that's the second trade. And then the third trade, I'm just going to highlight your VIX call and just show you a potentially better choice. So let's say you were saying you're going to do a $20 VIX call. Well, that would look like this. And the problem with VIX calls, obviously, like I said, with the VIX all the way over here, not only do you have to get the direction right, but of course you have to get the timing right as well, because this is a theta negative trade. You're going to be bleeding money every day that you're wrong. But let's scale this to the same $1,000. So what is that? About 11 of them? Close enough. 1,045. Let's say the VIX goes to 25. This person can make as much as $4,500. Betting 1,000, making 4,500, that seems pretty great, right? But there's actually something else that we can do instead. We can use the same 20 strike, but we can just build it into a vertical instead. So that's going to look like this. Now I'm going to adjust this. Instead of a 20 to 21, let's do 20 to 25. With the VIX call, we were saying that person can make the money at 25. They can make $4,500. Well, this person is betting 36. So let's do 30 of them. That gets pretty close. Let's drop it down to 29. How about 28? Pretty much exactly. 1,008. But if the VIX goes to 25, this person makes almost $13,000. Obviously, that's a superior trade to a straight up VIX call. The reason this is happening is because you're essentially sacrificing what would happen if the VIX all the way to 50 or 60. And you're basically just saying, no, if it goes up, it's going to be something reasonable. I want to get all my money right there at 25. And I would just forego everything over here. Now, I will remind you that if, for example, you wanted your number to be 30, like here, this person can now make almost $10,000 if the VIX goes to 30. Still has to break 20 to break even, but if it goes to 30, this person's going to be pretty happy making 10,000. I don't think that's very likely, but let's look at this, and you can just take that 25 to the 30. Make sure we're doing about $1,000. That's way too many. Let's go 19. Oh, nailed it. So now if the VIX goes to 30, this person can make almost 18,000. Now, vertical call spreads, again, low probability trade. You do have to be right on the direction and you do have to be right on the timing. This also bleeds down. But just as far as a risk reward ratio, you're essentially saying, well, I'm not actually thinking it's going to go to 60 or 80 or 100. I'm more thinking it's going to go to 20 to 30, somewhere in that range. This would be your trade. But again, I would actually default to the fact that even VIX getting to 20, I don't think that's a very realistic expectation. Obviously, one of these months it's going to happen. It's just a matter of time. But my style of investing, I am always thinking you are better off doing something like this. Or absolutely nothing wrong with just going for the straight up iron condor, covering a really nice range. You only need it to go up a little bit, can make a nice big profit in the middle. If it does go all the way to here, like I said, you can just exit the trade. So if you've been following my live streams for any amount of time, you know that I don't really like those speculative contrarian plays. Just because we think the VIX is low does not mean that the market just has to spike and it's time to pile into the VIX calls. Even if it's been 4 or 5 months of stability, we do actually still have to play for the most likely scenario. And in this case, yeah, sure, the VIX might creep up a little bit higher, but I don't think it's realistic to expect that this is going to be the time where I'm going to slap my money on the table. It's going to go to 50 and I'm going to just pay off like a casino. I don't think that's a very good way to trade. I don't think there's anything wrong with saying, look, the VIX is 13, 14. I wouldn't be surprising if it goes somewhere 15, maybe 18, 20, maybe even to 25. But past that, you're really going to have a super low probability of nailing it. So I would stick to something like that. Iron Condor out of the money, so it makes sure that it's skewed the direction that you actually think it's going to go. Broken Wing Butterfly, again, transfer all of that risk down to the side where you think is the least likely, which is low VIX in this case. Or if you really want to roll the dice, go ahead and stretch those strikes out on a vertical call spread and just target that number that you think it's going to go. Yes, you are capping the very high side. You're not going to make, millions of dollars, but you are actually going to get paid an insane amount of money if you time that. Personally, not a trade that I would put on. I would stick to the other two. And for me, of course, broken wing butterflies are kind of my thing. So that's the one that I would default to if it was me, but always go for the higher probability trades. So now you can start populating the comment section with all your questions. We're going to get to the open Q&A. But before we do that, just a very quick 1-minute word from our video sponsor. Hey everybody, so please just allow me 1 minute of your time to introduce my work, and then we'll get right into the live Q&A. So I launched VTS in January 2012 with 2 main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 5 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for 18 years now, and I share a lot of invaluable volatility data from our dashboard in every daily email to subscribers, so you can learn the same tools responsible for my success. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS available to everybody down in the description below or on my website. Come join members from almost 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so this time I just want to make sure that I hit that echo noise cancellation button again. After I play that little ad reel, that 1-minute ad reel, word from our sponsor. Last time I didn't actually unclick the echo, so I can feel it kind of phasing in and out. Apologies about that. I know it's actually quite annoying. I did that full presentation on the UVXY reverse split, and unfortunately the audio was slipping in and out. And sometimes people ask me, if you're going to go on YouTube, if you want to start doing videos for your business, what's the most important thing? Should I get this camera? How do I set up my studio? By far, the most important thing is audio. So as long as you've got a good microphone and you actually know how to use it and you don't screw up as often as I do, you should be good to go with just the audio. So let's actually get into the second thing that I wanted to talk about, which is, of course, my live streams are free. They're totally public. I blast the links out on YouTube, on Twitter. Everybody can kind of come and go, and you don't have to super chat. You don't have to pay any money. But of course, we do have a significant percentage of the VTS community that will also at some point watch the live stream as well. So we took a new trade. I can actually show you that. Let me pull that up really quickly here. Just kind of explain what's going on, but I'm actually going to execute the trade that we took within our VTS community live here. So it's a calendar option, and essentially you can see this is today's email, 1 new trade, and it's in the Iron Condor strategy. So currently we have 4 strategies in our portfolio, equal 25% weighting, and you can see 1 new trade, only the Iron Condor strategy. So the other 3 actually have been pretty stable for quite a long time. So defensive rotation, we're holding 2 times the NASDAQ. So we're holding the QLD, and we actually entered this position quite a while ago. Right there on November 1st, there was a little bit of drawdown there. We're in safety positions here. And then we entered this position there, and we have not exited since. So actually pretty boring, but of course we are trend followers, at least for these first 3 strategies. So nothing wrong with basically making money hand over fist, being 2 times NASDAQ. I'm not going to take trades just to take trades, right? Obviously, I'm a trend follower. As we always say, the trend is your friend. I'm not getting off this train until the volatility metrics tell me to. So short volatility, kind of the same thing. We've been holding SVXY for a very long time. We did exit for, I believe, 2 days along this streak. So we entered again November 1st. I think we exited for a couple of days here into safety gold. But other than that, again, riding a trend. And this one hasn't exited either. So again, our first 3 trend following strategies basically have been pretty boring. I think people are kind of thinking, well, are we going to get some trading in? Well, the Iron Condor strategy, we actually can do some trades, but unfortunately, Iron Condors, when the market is consistently marching higher, that is actually the worst environment for an Iron Condor strategy. So we have as many as 3 trades available to us, but I've actively been trying to reduce the allocations and basically just playing with a single position. So it's, for me personally, investing is 100% about making money. So I am not disappointed at all that we've basically just been for the last 5 months watching and participating in the market, both short volatility and 2 times equities. So we're making a pretty great rate of return. But I can understand a little bit why people might want some trades. So we've got one going on. This is the calendar option. But if you're actually curious about why I just said that this is a terrible environment for Iron Condors, if you remember, I do have a clips channel, right? We have the main YouTube channel, which you're watching now, but there's also a little clips channel where I just cut up stuff, questions people ask, and I throw them up here. So you might want to just check out some of these titles, see if anything jumps out at you. This one right here, Iron Condor traders always make this costly mistake. Little clickbaity there, trying to get slightly better at YouTube. I suck, I'm old, you know how it is. But watch this video. Essentially, I'm explaining that, as you hopefully know, Iron Condors is a market neutral strategy. It profits when the underlying you're trading stays within a reasonable range. Now, it has a pretty big margin for error, so it doesn't have to pin to any price, but it doesn't really like strong trending markets. So if you were to ask me the question, which is better, strong trending up or strong trending down, they're both not great, but strong trending down is far superior because the Iron Condor is what's called a short vega trade. It's short volatility. So if you imagine a trending market just marching higher like we've seen in the last 5 months, not only is it breaching that upper end with the Iron Condor, but it's also doing it with lower and lower volatility. So every subsequent Iron Condor you open is going to be a progressively worse trade than the previous one. So if it's going the other way, Iron Condors are not great in a crashing market initially, but as you imagine volatility starts to rise, let's say 2022, for example, it's just consistently breaching that mark. But every new Iron Condor trade you open is a wider, stronger trade than the previous one that may have stopped out. So you really only stop out once or twice, and then you start getting some really good trades again. And so for 2022, as an example, we actually made 26% in the Iron Condor strategy. S&P down about 20. We made a really good rate of return in that strategy because it was trending downward, but it was down. So that's fine. We get high volatility. We can open really wide wing Iron Condors and everything kind of works out. The worst is this, consistently raging higher market that we've been seeing. So unfortunately, we are really just playing with this single position. But I'm going to go ahead and open this trade live just so the VTS members can see it. We actually haven't traded a calendar in quite a while. We typically trade Iron Condors, but let's go ahead and open this trade. So here's the instructions. I will refer back to this. But one thing that I also want to do, we are going to be trading the QQQ, first of all. So let's go recently. I actually want to just go through the quick rules of engagement for the strategy, because there is a slight difference between Iron Condors and calendars. Again, VTS members, this is direct for the trade that you're going to be opening right now, but there would be no reason why everybody watching for free right now couldn't also open the trade. Now, if you don't know what I'm talking about here, just open a 1-lot contract size. Don't go heavy on this or anything. It's not a trade recommendation. It's just, for education only, all that disclaimer nonsense. But if you want to see the full video for this, actually you can go to the main YouTube channel, just type in anything you're interested in. Type in VIX, VXX, whatever. Here you can type in iron condor. You can see I've done, countless iron condor videos. It's kind of part of our portfolio. But this one right here, the iron condor rules of engagement, you actually need to watch that video. It's about 15 minutes long, covering all of this stuff. But let's go through this super quickly. I'll just highlight why calendars are different. So first of all, we only trade highly liquid ETFs, no individual stocks, of course. They have corporate announcements. They can crash really fast and hard. We don't want that. We want consistent trending markets. Like, chopping around sideways is great. So only highly liquid ETFs. 2, iron condors during mid to high volatility, which is the majority of the time, and then calendars when it's low. Now, again, just what I said, it's not actually low right now, but it's low-ish, so good enough. We'll do calendars. Number 3, we don't open new trades during strong trend points. This one, we're kind of going to violate that a little bit. Essentially, what I mean is, if you imagine a normal market that does see some corrections quite consistently, not like this market we've seen, but this would be a better entry point than there, for example. This would be a better entry point than here. Usually you want to wait for a couple of days of weakness and then initiate your next trade. That way it gets you a little bit closer to the medium-term average, and maybe you can avoid getting stopped out really quickly. But right now, again, we're only playing with one single trade, so we're going to go ahead and violate that rule and just keep going. Number 4, 45 to 75 days to expiration. Pretty self-explanatory. We are actually, when we take this trade, we're going to do this one, right? The 86 is a little bit too far. We're going to do the 51 because it's within that range that we're looking for, 45 to 75 days. Number 5, we target about 15 delta on the put and call side. That's for iron condors. Calendars, we use at the money, of course, because it's not an iron condor. We're not using out of the money strikes. We're going right at the money. You'll see that in a minute. Number 6, 3% net liquidation value per trade, and that is for iron condors. Calendars, this is important, we only use 2%, because a calendar versus an iron condor, the calendar is actually a bigger trade, right? It's even more capital efficient than an iron condor is, so you have to reduce that even further. Keep that in mind. I will calculate it in a second. Number 7, we allow for as many as 3 trades to be open at the same time. So I showed you that we could, in a good environment, be churning multiple trades. And of course, we'd be using different underlying indexes, SPY, QQQ, we could use the TLT bonds, GLD gold. We want to get a nice diversification going, different time frames, different expirations, different volatility levels. That's what diversification means. But again, right now, we're just playing with a single one. Number 8, iron condors use a 50% stop loss, stop gain. Now, calendars, again, because it's a different risk-reward ratio, we actually drop that down to 25. I will put those right on the trade when I open it. You'll see what I mean. Number 9, we only add additional layers in the same expiration if it moves more than 4%. Essentially what this means is there would never be any reason to open 2 trades that are the same trade. So if you open one iron condor and then 5 days later the market hasn't moved, you wouldn't open another one. That's basically just the exact same trade. So we need at least 4% movement in either direction before we initiate a second layer, right? It's just a point of diversification. You want to make sure that each layer you add is significantly different from the previous one. And then number 10, they should be traded independently of one another. So all that means is I don't do anything in the iron condor strategy because something's happening in these 3. If this one's in QLD or if this one's in cash, I wouldn't take a trade here just to supplement this one. This is a standalone. We just trade it as a market neutral strategy. It does add diversification on its own, but that's not intentionally what I'm trying to do, actively trying to balance it out with the rest of it. Just treat them as independent strategies. And so now let's go ahead and execute that. So all you do, if you're executing iron condors or calendars, go to the ticker, right? You're going to look at your instructions. I try to keep them very basic. This is general options lingo, sell to open, buy to open. The open means, of course, we're opening a new trade. If we were closing it, it would say, buy to close, sell to close. That's just option lingo. The dates are really important for calendars. Obviously important for everything, but it's especially important for calendars. So remember, I'm doing the 17th of May. Watch what happens if I go down to the money, right? Remember, our instructions are for the 440, right there at the money. If I just buy, actually, I'll do an analyze first, buy a calendar, watch what happens. Down here, it filled in the trade for me. So I have a 17 in May, that's the short strike, that's good. Calendars short the front month and they go long the back month. And then it populated the 21 June for me. And the reason I'm making such a big deal about this, you can see on the NASDAQ, there isn't any weeklies or quarterlies happening in between here. But if you were to trade something like the SPY or anything that has a lot of strikes available, it will probably populate the closest one. And you might actually get short the correct one. And then when it adds the long, it might be using one of the weeklies. And you don't want that. We want to use the 51 for the short and the 86 for the long. So in this case, for the Qs, it's great. It worked out just fine. But just be aware of that when you see your instructions, make sure that you actually check these dates. Because again, if you're doing it on the SPY, it's almost certainly going to populate with the wrong long strike. So just keep that in mind. So this is what the calendar looks like. It's essentially a market neutral trade. Price is right here in the middle. We don't care if it goes up or down. We just don't want it to go too strong in either direction. Now, when I mark the stop losses, you'll see how wide this actually is. But the first thing that we're going to do is adjust the contract size. This is, again, that part where I said calendars use a 2% allocation, net liquidation value. I put that right there. All that means, very simply, this is our live stream account, 60,600. I would just take 60,600, take 2% of that value. This is how much money I'm going to spend on my iron condor. It's going to be 1,202. And for a debit spread, debit means you're paying to open something. An iron condor is a credit spread. You're selling it. For a debit spread, you just divide by the premium. So all you do is just divide by 299, and this is how many contracts you buy, 405. Now, don't buy 405. Remember, one option contract equals 100 shares of the underlying. So you do have to divide by 100. I'm going to open 4 contracts. That's all that means. Very simply, I'm just allocating 2% of my net liquidation value. This is the trade. Now, the last thing that I said I would do is I would actually go ahead and mark those stop losses right on the trade. Because calendars, we're going to use a 25% stop gain stop loss. That means 25% of this premium I'm going to stop out. So all you would do, again, very basic here, all you got to do is see this once or twice and you're just going to get it intuitively. Obviously, the 30 video Iron Condor course that you have access to, it goes through this a lot slower and there's multiple videos, but this really isn't that difficult. So 298, all you would do, 0.75, that's 25% loss. 223.5. I typically round up, so 224. If this premium at any point says 224, I would stop loss out. Actually, I should click this so you can see it. If this 298 goes down to 224, I stop loss out. If you would rather see it in dollars, just multiply by the number of contracts. So remember, it's that 400. $894. I can actually go ahead and just mark this right on the trade. So you can see the pink line. I can go down to somewhere close enough to there. That's the lower stop loss as of today. And then another 888 somewhere around there. That's my upper stop loss. So you can see, even though it looks like a really tight distribution there, whereas an iron condor would look like this, right? It would be huge. They're actually the same risk reward profile. Don't let this shape fool you. It does not have to stay in this range to make the money. This pink line will be ticking upwards every day, right? Because it is a theta positive trade. We're going to be making a little bit of money each day that nothing happens. That's the point of trading market neutral positions. So don't be fooled and think, oh, wow, this is terrible. It has to stay at 440 or I'm going to lose money. No, actually, it has to go between these 2 points. So that's 405 to about 497. If you want to see where that happens here, this secondary hash line is the May expiration. I can just mark 405, somewhere about there, to just under 500. This is actually what we're talking about. So with the calendar, again, pretty big margin for error here. We can, come on, click on there. We can actually expect the market to be doing something like this. And truth be told, because we've got that stop loss there, remember 298, if this goes up 25%, we are going to take our gain. So we don't have to wait until expiration. We're going to be out of this thing pretty quick. So what it's actually going to look like if we're really talking about realistically, in about 3 weeks, we're probably expecting it to be somewhere here. If we can get that, we're going to be taking our profit and moving into cash, and then we will be able to open a new trade, right? This is the point of iron condors. This is the point of calendars, is that they are market neutral. For our portfolio, if it rocketed higher, that would be fantastic. We'd have 3 strategies that are benefiting strongly from that, and maybe the calendar loses money, right? That's kind of what we're saying here. If it goes down, our other 3 strategies will rotate into safety, right? Because they are tactical. As soon as volatility elevates, we're going to be out of those things. And then maybe the calendar loses money, but volatility will be so much higher then, I would actually prefer it to be down here, because the next trade would be an iron condor, and it would be stronger than the previous trade. So that's it. I would actually just execute this trade. Now, if you want to see that live, I can just go to the trade tab. This is Thinkorswim. I'm sure your software is very similar, but all you do is you input the calendar, you buy the calendar. Now, you would go through again. Make sure you just do a real quick double check. Make sure that you're selling the May, you're buying the June. I would always keep the trade signals up in front of you. Okay, I'm selling the May, I'm buying the June. Cool, we've got that right there. 298, doesn't really matter. We're just gonna try to get a good price. I would calculate my contract size. In this case, remember I said it's 4, and that's it. Now I'm gonna use essentially what is the 30-second rule. So I'm gonna try to get a slightly better price than I think is available right now. If you look at the mid, 297 to 299, it's kind of bouncing around. I could maybe go on the low end and just throw it up there in the queue. So the first thing that's gonna happen, it's gonna go up here. I'm gonna see 297 is what I'm trying to get. 298 is where it's at. You would wait 30 seconds, just be patient, 20, 30 seconds, and then just casually change the price up 1 penny until you get it. So if this was not a live stream, maybe I'd wait 10 more seconds. But all you do is just keep cranking up until you hear that bell, and we are good to go. That is it. So now, basically just hoping that the market stays reasonably stable. Again, even if it goes down, we've got some margin for error. Even if it goes up even stronger than it has been, we should still be okay. This is actually a pretty wide range. Again, I know it looks narrow, but in a practical real-world sense, calendars and iron condors, even in a low to mid volatility range like now, you've got 5 or 6% at least on either side. And if you're opening, say, iron condors in a high volatility environment, like if you opened, I have an article on my website, I showed an example opening an iron condor during the financial crisis. The width of it was like a 33% margin for error on either side. When you're opening iron condors during a market crash, you would be amazed how wide those wings actually get. It's actually quite a good strategy for that. A lot of people think, oh, iron condors are great, they're market neutral, but you're gonna get crushed in a market crash. Yeah, you might get 1 or 2 trades that stop loss out, but every trade after that is going to be stronger than the previous one that stopped out. And eventually you're going to get 4 or 5 winners in a row. That's really easy because, I mean, your wings are going to be 20 to 30% wide on either side. It's actually pretty cool when you see it happen. So obviously, tune into the live streams. I will be back when the market crashes, and I'll give you a bunch of trade ideas and options ways that we can play it a little bit safer. Like I did in the first segment, I'm not a big fan of just rolling the dice. I'm more a big fan of, there's nothing wrong with having a slight directional bias. Like if you want to do a slight out of the money iron condor, that's fine. Broken wing butterflies, that's fine. You just don't want to be the type of trader that's always enamored with, buying out of the money calls on AMC and just that kind of thing. You're not going to have a whole lot of success if that's the way you trade. So kind of dial it back. I'm much more of the conservative trend follower with some market neutral options. Maybe dial it closer to me. You can still roll the dice if you really feel like you've got something that you just, for some reason, you think the market's going to crash. All right, throw a couple contracts, but I would much prefer the market neutral stuff. So, all right. That didn't take too long, did it? It actually did. Apologies, but hopefully everybody enjoyed that. 4 option trades today. And like I said, they're not trade recommendations, but you could take those trades. Just keep it small. 1 contract size is fine. All right, let's get through a few of these questions. Also, thumbs up. Now's the time. It took me 40 minutes to ask, so, give the video a thumbs up for me. Do you also take into account option dealer positioning in your strategy? I see some people guesstimating. I like how you use that word because that's what it is. Dealer positioning to predict ranges depending on time to expiration. I don't consider what you're getting at. You see a bunch of these gamma exposure, these dealer positioning type of accounts popping up on Twitter in the last couple of years. No. And essentially the reason, I'm not outright saying it doesn't work. I know one thing that you could say for sure is that it is easier to decide when volatility itself might be rising rather than the direction that is going to cause the market to go because of the dealer positioning. That's the part that I would question. But yes, if you're seeing something develop and you're good at spotting those signals, you could consider it one of several metrics. But I don't think it's even close to like a top 5 list, right? Even if I knew with certainty the exact dealer positioning, I would still default to several of my more robust trade signals long before this one, right? This is the same thing that I've always kind of said with things like seasonality, things like moving averages and stuff like that. I'm not necessarily saying it's totally useless. I'm just saying that it's like number 7, 8, 9 in a list of things that you would be factoring into a trade. I'm certainly not going to buy or sell anything based on dealer positioning. That would be ridiculous. And I do also say it's a little bit convenient that the people that have those websites don't actually show any performance, because it's much easier to sell the story of dealer positioning is this, they're going to have to do that, it's going to mean this much open position, while they're going to have to roll out their calls and they're going to be hedging over here, and this is exactly what's going to happen, right? They can tell this A, B, C, D story, and it sounds like, yeah, that's exactly what's going to happen. But then how are you actually going to trade it? Are you really going to sell your portfolio because of that? No, you wouldn't. There's many, many more important things to get to first. And then, way down the line, you might be able to consider something like that. But I have yet to see a track record of somebody who's claiming that it works. So when I say things like that, I'm not saying it doesn't exist. I'm actually, mining for information. Do you know of any? I would love to see that track record. I will give it a serious, open-minded, objective look, but I have yet to. All right. Wife saying hello. Probably still watching me from Taiwan. What is it, 12:41, almost 1 in the morning? She doesn't go to sleep till 3 or 4, so hello. Can we have 2 live streams every week? Yeah, we did one 2 days ago, so it just so happened that I thought there was 2 pretty important subjects. But again, one thing that I might want to run past everybody, you can just leave a comment down below. What would people think about doing more of these, where it's like a single segment and then answering questions about it for like 20 minutes, and then maybe doing 2 of those a week, rather than what we sometimes or typically do is like an hour-and-a-half live stream, 2-hour live stream. What if I did do 2 or 3 shorter ones? Leave your comments down below. Normal 3 per week. No, I think people would get pretty bored of me pretty quickly. I'm not that entertaining. I'm not that exciting. Let's keep it to a minimum. This pre-recorded, is that a question? That or your off-the-cuff delivery is world-class. Thank you. I take that as a compliment. This is a live stream. It is totally live. But I will say that I think the reason why it may have looked that way, I'm not sure if you're aware of this, but as I've pointed out a few times in the past, the reason I don't actually play these as, how they're supposed to be played, where I don't even know if you can see this. Can you see this if we're clicking through? That's actually a good test for me. I can test after, watch the rebroadcast. But if you play it as a slideshow, I can't see the side columns. The reason that I just say, you know what, screw it, people can basically get the point, is that I can see what my next slide is in my head, and I can kind of spool it up a little bit. So I'm looking over and I know that, okay, after I'm done talking about this, I can just boom, boom, I can just go right through them, and I can see it sort of in my peripheral vision there. So perhaps that's why. Otherwise, I think that, I don't know, I think fast, I talk fast, and this is just the way it is. So I don't know if that's a compliment or not, but I will try to take it as one. Not sure if anyone has timed a volatility spike, but what happens in the period after a spike is pretty well-known phenomenon. Not that I've practiced it enough. I guess what you're talking about basically is, standard operating procedure for fading VIX spikes. I'm not sure if it's well-known phenomenon, but volatility will definitely go down at some point. It's just when, right? I think just in general, there's far too many people that fall into these templates of thinking that, okay, volatility does this. This is what's going to happen to the VIX. This is what always happens to the VXX, the UVXY. It's going to stay up for 2 or 3 weeks, and then it's going to come back down. I think people should get that out of their head, because there's absolutely going to be markets in the future where none of that is true, right? Even during the pandemic, volatility spiked an insane amount, but the government went to extreme lengths to make sure that it stopped crashing and injected trillions of dollars into the economy to get it to go back to normal. And that's not going to be there anymore. So don't be surprised if we do someday get a spike, that volatility goes up, the market goes down, and it could take 5 or 6 years, literally years, to get back to break even. You got to remember that on an inflation-adjusted basis, the S&P 500 from the dot-com bust didn't actually break even until 2016. So you're talking about a 16-year period with no gains when you back out inflation. And that's backing out the government inflation number, which we all know is definitely way lowball. So it actually probably took 17 or 18 years just to break even. And the VXX has had many periods in the past where it doesn't bounce back after 2 or 3 weeks. It can take months and years, right? It really can do that. So I'm not sure if it's a well-known phenomenon, but I hope you are ready when it happens. I'll come back and I'll try to steer people towards the higher probability stuff. I know most people will just say, oh, let's just short the UVXY. Well, no, that's not what you do, because I shouldn't have highlighted this one until I'm done my thought here. You got to remember, people don't really dive into the data too deeply, but how big of a spike are we talking about, right? Because financial crisis, VIX went to 80, pandemic, it went to 82. I think people would be surprised to learn that for some reason people think the VIX has a ceiling, like 100. It can't go over 100. But if you use the VXO calculation, which was the S&P 100 on the VIX before it switched over their methodology, it actually went to 172. So, 1987 stock market crash. If you were the type of person that saw the VIX go to 50 and you think, well, it's only gone to 50 4 times, I'm going to short here. And then it goes to 80 and you think, well, it's only gone to 80 twice, so I guess I just short again, I just double up. And then if it goes to 150, then what do? It can actually, because it's exponential, you shorting at 80 could blow up your account as well, because it could actually go to 150. And that would be the same relative move as it going from, 20 to 80. It would be extremely punishing when that happens. And I always say, just accept the fact that once in your 20 to 30 year time horizon, something like that is going to happen. Don't plan out your trading strategies so that you make money for 20 years and then you give it all back in 2 days. That's going to happen to us, right? So don't do anything too crazy. Always, always, always defined risk no matter what. Okay, sorry. He talks in real time. World-class communicator indeed. Okay, so compliment train. I like it. I didn't even trade VIX, but I just like listening. Okay. Well, I'll take that as a compliment, but something that I've been actually considering is pre-recording the first couple of segments, because then maybe I could do 2 or 3, and as people know, I can ramble a little bit. I could probably cut these live streams down a good 5-10 minutes. Like that presentation I did, I would imagine I could shave 5 minutes off that if I pre-recorded it. There was probably, I haven't watched it back yet, but there's probably a few things I didn't actually need to say. My brain just goes off on these tangents. But if I started pre-recording things, I don't know, it might actually save us some time. So I'll slip one in there, a pre-recorded. I'm not going to tell anyone ahead of time, and then I'll ask for feedback afterwards. Can't trade the VIX, any VXX demonstrations. Always. Yeah, I mix it up. It's just that person asked specifically about the VIX. So the the VIX and the VXX are, of course, not the same thing. It's a different underline. But in this case, I would say that the same general principle applies. You could do an out-of-the-money iron condor, but you can't go too far out of the money because it's not a cash-settled index. So you don't want to start your trade with in-the-money options. And then you could do a broken wing butterfly, but you're going to have to stretch it out much wider. You're going to have to start where the price is right now and stretch it out there. The one that I said, the vertical, you could do that one because you're not going to have out-of-the-money options there or in-the-money options. But, you know, the VIX is cool because you can do anything you want. Like my VIX option strategy, it's really normal to have at least half those contracts there in the money, right? And you don't have to worry about it at all. So my VIX option strategy literally would not work on any other underline. It has to be the VIX. Okay, why don't banks do such quantitative analysis and sell something better than a buy and hold pie chart to their clients? I wish that was the case. Wouldn't they have big competitive advantage compared to other banks? So I've been going in pretty hard on these buy and hold stupid pie chart things in the last couple of weeks, and I think I've got one more coming because for some insane reason, there are people who actually trust the government when they release the inflation numbers, which blows my mind. Like, people distrust the government about literally everything, like the school system, the politics, the tax system, the pandemic, everything. Everybody says the government's lying all the time, and then it comes to inflation. They're like, how dare you question the inflation number? Of course, this 7% annual buy and hold pie chart, inflation's only 4%. Of course I'm going to make 3%, right? The government wouldn't lie to me about inflation, something as important as inflation, but they lie about everything else, and we complain about it constantly, right? So I guess I'm going to have to go into a little side rant about the reasons why. Of course, the inflation number is significantly understated. I think everybody kind of knows that. But yeah, I've been going in pretty hard about these pie charts because I just don't want people to go their entire life making a rate of return that sounds positive, and then when you back out inflation, it's zero, right? If you do a buy and hold pie chart and you make 6 or 7%, which is all they're really going to make, you've made nothing. You're going to go 30 years, you've made nothing. The asset manager is going to be a millionaire, but you make nothing. So why don't they do more? So let me give you a couple reasons. There's many. I could make a video on this. In fact, I probably at some point should. One reason would be, why would they want to? If you think about the system right now, very few people, it's set up so that very few people in the asset management world show performance. Now, hedge funds, sure they do, but there's other reasons why it's a trade-off, right? I'm sure that many hedge funds, most hedge funds, do not want to show performance, but they get a lot of the benefits because the legal structure of a hedge fund allows them to do other things that they couldn't normally do if it wasn't a hedge fund. So it's a trade-off, but they definitely don't want to show their performance. Competition is not a good thing in the financial industry because right now there's trillions of dollars locked up in the industry. It is much better that nobody shows performance. 90% of the management is essentially these silly pie charts, buy and hold. Every asset manager on Twitter will tell you to just buy index funds and sit there. Of course, they're telling you, they're literally saying you will make $0 because remember, inflation's a real thing. So, but they make millions of dollars. I mean, how fantastic is that job? Of course, asset managers, financial advisors, financial planners, of course they're going to tell you to buy index funds. How easy is that? You don't actually have to learn how to invest at all, and you can make millions of dollars just taking 1% of your clients' assets every year. That's fantastic, right? But if you have a situation where everybody's encouraging competition and, you know, would be fantastic to see everybody starts showing performance, well, now all of a sudden, there would be very few players that would have any chance to get any clients because performance would be all that matters. So there are some people who, you know, of a rare few, maybe 5%, 10%, who would like a system where performance mattered. But 95% of the people would have no job anymore, right? So the system's fine right now. It's not broke. It's all set up to keep the money locked in there, keep clients in the dark. The only way you're ever going to know that you're underperforming is to actually give them money and let them manage it for 10 years. And then you'll see, okay, I've underperformed. Now what? Well, I guess you take your money out of JP Morgan and you go down the street to, you know, Morgan Stanley, and you underperform for another 10 years. And they get the money the whole time, so they don't care. I think that's a lot of it. Yeah, it's just, why would they do that? Why wouldn't they set up a system like now? It's absolutely perfect. It's one of the best industries in the world to work for. And there's very few, I'd say only maybe 10%-ish that actually know how to invest. I mean, your run-of-the-mill financial advisor doesn't invest. They don't trade their own money. It's the actual traders that do that. But the system is set up so that performance is not a thing, right? They have rules. You can't solicit clients. You can't show performance. You can't, there's all these roadblocks. So can't beat them, join them. Let's just make the entire thing about marketing and let the chips fall where they may. I think it's set up pretty great from the aspect of the roughly, 400,000 investment advisors in the US, and I mean, over 1 million worldwide, I'm sure. It's a pretty great system for 1 million people. It's just absolutely terrible for clients because they have no way to vet any of this, just, I don't know. As you can tell, I'm very negative on the way the financial industry is set up. To me, it's heartbreaking that they are herding everybody into these portfolios. The asset manager knows full well that you will not outpace inflation. They know that ahead of time. So you got to remember that when you're in that meeting and they're telling you that this pie chart that they want to put you in makes you 7%, you have to know that the person across from you at that desk knows that you're going to be broke in retirement, and they're going to take your money anyway. Just remember that thought, that if they're not trying to beat the market, they are telling you, you will not beat inflation and you owe me 1% a year. That's what they're saying. It might sound like a great marketing pitch, but essentially they're saying, I don't care about you. I just want a big house. So here's what I'm going to put your money into. The bank has already prepared it. You get 3 choices. Are you aggressive? Are you a little younger? Are you conservative? Are you this? We're going to put you in one of these and it's going to be magic. And magically, you will have only the money you saved yourself in retirement. You will not have compounded anything. So it's a fantastic system if you really think about it. I mean, just the nefarious financial industry, it's very, very advisor friendly and very client, oppressive. I was surprised by the following response from a broker. Let's find your follow-up. At the end of the trading day, volume drops on an iron condors and the bids get out of line with the underlying instrument. So the risk is too great that your iron condor will sell when you don't want it to. What? Are you talking about market orders on options? If that's the case, I'm just trying to piece this together. If you're talking about market orders on options, don't ever do market orders on options. Always limit orders. You want to, it only takes a minute or two to get your trade done. Don't, even with stop losses, stop gains, don't do that. Don't preset them. I encourage people to check their trades every single day. Of course, I will send the email when we get the stop gain or the stop loss anyway, so you will be notified. But you just get into the habit of checking your trades every day, like that calendar option. Every day that you go in there, just once a day, you don't have to be religious with this, just once a day, just pop your little stop gain, stop loss lines on there. And if the price is in between this, you just go on about your day. If it's not, at that point, you've decided that, okay, my stop has been breached, then I'm going to go in with a limit order and actually make sure that I get something close to the mid price. But if I'm making a huge assumption that that's what you were even talking about here. But don't ever do market orders for options, especially a 4-leg option. You're probably going to be screwed on that, especially in a fast-moving market. Have you considered using SSO instead of SPY? So there have been periods in the past where our strategic tail risk has used SSO 2 times the S&P instead of the SPY. But right now we're using 1 times. We're already short vol. We're already 2 times here. We have plenty of market exposure. So no, not now. But if you imagine when would be the best time to potentially get aggressive, I would say that if there is a significant market crash, then after you come out of the market crash and things calm down, I would be more willing to take on leveraged trades then. But I would I'm not saying the market's going to go down anytime soon. As I've been repeatedly saying, time itself is not an indication of when we should get out of these trades. The volatility signals will tell us when to get out of the trades. And until then, I'm going to ride the trend. It might stay for 300 more trading days. But now would not be the time to be looking for additional leverage, in my opinion. Because if you really think about it, I mean, how far do you want to go with it, right? There is the TQQQ, which is 3 times NASDAQ. There is the SVIX, which is double the SVXY. And there is like the UPRO, for example, 3 times the S&P. How far do you want to go with leverage? We already have SPY, short vol, which remember the beta to the S&P 500 of the SVXY is over 1. It's pretty close to 2. It's already a 2 times leveraged S&P product, essentially, right? The correlation's only about 70%, so don't think it's somehow, the same thing as the stock market. It's not. But it's already beta factor much higher than the SPY. And then, of course, 2 times the NASDAQ is already leveraged. As I always say, if there is a reason why 20% a year is not good enough for you, then that is a you problem. That's a budgeting problem that you have put yourself in by either not having a high enough income, by spending too much money. I'm not criticizing you. I'm just like the general everybody you out there. 20% a year, even 12% a year. If 12% a year forever is not enough for you, then you have to look at your life decisions, not your trading strategies. You should not be looking for more leverage than we currently have on. We are already well over a 1-to-1 beta factor to the S&P 500. We're like typically about 1.3, 1.4 at least. So no, I would not. Of course you can. I mean, your question is, could you do it? Sure. But no, you should not be looking for additional leverage, especially not now. Regarding stops, setting stops. Yeah, so I kind of guessed right. Don't put stop loss orders ahead of time. Just get into the habit of checking your trade once a day, checking my email once a day, of course. You have to do that. And yeah, it's no big deal. You're never going to miss anything that way. You just don't want to get the terrible pricing that a market order would put you in. Okay. Here we go. What's the thought process behind choosing Qs instead of SPY? The IV percent on SPY all look lower than Qs. Yeah, I think it's slightly lower. I think that the last time I checked, if you are the type of person that looks at the IV rank, what is that? INF percent. What does that mean? Let's see if we can reset this. Come on, typing. SPY. What am I doing? My fingers are broken. Okay, so current IV is 8. I think the Qs was 13 when I checked it. What is it? Is my internet... Hopefully everybody's here. My internet seems super slow. It's actually lagging and interfering with my typing. So 14, basically the same thing. I just chose the Qs just because we're cycling into different things, and I like to kind of mix it up a little bit. I'm using that example as an example inside the course. So eventually, maybe not tomorrow, but eventually I will edit that down, condense it a little bit and throw it into the course. And I thought we should have a little bit of variety in there, so the Qs. But the IWM that we came out of our iron condor, its volatility is higher recently. So I would not have used that for a calendar. SPY Qs, basically the same thing. Okay, hand pink waving. What? Don't know what that means. Sorry. Squeeze Metrics thought that GEX would become an indicator at some point, not a scammy stock service. I mean, I've never paid any money for anyone else's service, so I don't even know what's inside it. I just know that, yeah, Squeeze Metrics on Twitter, it's very GEX heavy. It's all of that stuff, dark pool datas and stuff. I think, honestly, I'm not saying it's not valid. Like it's coming from real data. I just have a real problem when you take, okay, you've got the data in your hand. Now what, right? What trade signal does it show? And you should definitely be able to show me a mock-up model portfolio at the very least that shows impressive returns, right? Because if you think about my work, here's what I do. I'm a volatility guy. So I'm mining volatility data. I created my own volatility index using 13 different volatility metrics. I could show you a back test. Okay, short the S&P 500 when this is below 60%. Here's the back test. It would look impressive. If I just went to our volatility metrics, I could tell you, if you use the VX30 to VIX roll yield and you go short, short VXX if it's below 65 percentile and you move to cash if it's above the 65th percentile, that's going to be an impressive performance. And if it's a robust metric, you should be able to do that in 10 minutes, right? It should be no problem at all to show somebody an actual example of how to use it. Not a story that takes 2 paragraphs to explain, just if this, then that, here's what it looks like on a chart. I've not seen it yet. And I've actually emailed him asking for that. Just look, I'm open-minded. Just show me something. It's always, well, I mean, you don't understand. If the dealers do this, then of course that's going to mean that their next action is going to be this, and that's going to cause the market to do that. Got it. I understand the theory. Great. I'm, just as educated as you are. Show me numbers. Show me a chart. Show me how to translate this data into a robust trade metric that beats the stock market consistently. That's the part that breaks down, because they never actually show you what to do. Right? They can show you the gamma, they can show you the flip points, they can show you the options exposure, but what to do with that, right? Do you sell verticals at that flip point? Show me a test of selling those verticals at that flip point. That's all I'm asking for. I'm not doubting any of it. I'm the type of person that likes to see how to translate data into trade signals. Not just data for data's sake, not just data because it's cool marketing, not just data because it sounds high level and complicated. Data for a purpose. We're trying to use this to make money. Show me how it makes money. That's all I'm asking. And again, I'm not doubting, I'm mining for links, for charts, examples. If you're one of them in the comment section, send me something. I've got a public email. VolatilityTradingStrategies@hotmail.com or at gmail.com or at kajabi.com. Any one of those, send it to me. Don't just send me the theory. I get the theory. Show me how you're going to use it to make money. Ideally, show me how you've used it to make money. A real track record. That's never coming. But at the very least, show me some type of mock-up benchmark or backtest at the very least. That's still, it's like pulling teeth to get one of those. So if you ask me to show you a backtest of how to use the VX, pick any random one, the VIX to VIX 3M ratio, 20 minutes later, you got a backtest. There it is. Here's how to beat the S&P 500 with just that metric. Why is this so hard to get from anybody who does all the dark pool, it's just impossible. I suspect I know why. Okay. My actual question, I should stop. Calm down. Calm down. I don't want to make new enemies in every single live stream. All right. My actual question on SSO is why not use SSO instead of QLD? Meaning use QQQ and SSO. Oh, just switch them out? I personally like the QLD. So I don't want to tease this too much because there's a live stream coming up basically with something similar to this, but the general spoiler alert version is if you have a robust risk management system where you can actually rotate out of aggressive positions and into safety, and it's been working and you have a long track record of doing it, then it is okay to use leverage. So what you're saying is, why not just use 1 times the Qs here and then make this one SSO? Kind of the same thing, right? It's just that this is the NASDAQ strategy, and I like having this one that has the leverage. This is just how I've designed it. But what you're saying, I suppose you could flip those out. Is there any reason why you'd prefer to do that? Like, why would you want the 2 times in this strategy rather than this strategy? I don't know. I like the NASDAQ, and I like 2 times NASDAQ because this strategy manages risk very well. Now, I get what you're saying, but I like the way I do it. No offense to your style. Of course, you do what you want with your money. But profit, okay, I gotta trace a few of these. Again, this might be an issue where it's not showing me all the questions. Profit taking limit order GCC for Iron Condor should be okay. Limit order, everything limit order is fine. Good till canceled. Limit order good till canceled? Yeah, I mean, why? You're gonna check every day anyway. I just don't like, I don't like having anything preloaded. Basically, I've just always got into the habit of manually exercising all option trades. Perhaps because I'm on my computer for 12 hours a day, maybe that sounds a little easier for me. If you just can't find time, if you've got a job that you're either not allowed to check your computer, or you're just too busy and you just can't find the time, or you're, with your family or whatever it is, then sure, you could find ways to have it inputted and, loaded up in the queue. Just no market orders, ever. Okay, last one. Thanks for the stream. I saw a video of you in 2015 say you wouldn't recommend using leveraged ETFs at all. What was the reason behind you changing your mind over the years? Well, I didn't change my mind. So to be accurate, I did and still do recommend people don't trade leverage. But the reason that I trade leverage is because, and this is going to sound completely self-serving, of course, but you asked me the question, so I'm going to answer the question. I have a long, almost multi-decade at this point track record of managing risk. So for me to say that it's okay if I use leverage, I know this, give me a little bit of room to sound like an arrogant prick here. But if I say that I can use leverage because I know what I'm doing, that's different than me talking to the ether and saying, yeah, 2 times NASDAQ's just fine, guys. You can go ahead and do that. That is not okay. That is an unethical thing for me to say, because maybe not you, but there's a lot of people out there. The vast majority of people do not have the risk management in place to make trading on leverage profitable. They will lose more money than they make, right? If you use 2 times NASDAQ and you don't know how to cycle out into safety at the right time, it's just going to cost you, right? Little spoiler alert for that video, as I said. Just FYI, here's the Qs. Let's go back to a 3-year glance at this. You can see the Qs are above the all-time high, right? This is to be expected. The market just recently breached above all-time highs. There it is. Well, the 2 times NASDAQ is still in a drawdown. It's still 8.3% away from breaking even. That's because leverage hurts more than gains help, or drawdowns hurt more than gains help. If you look at the 3 times leverage, it's not even close to breaking even. It's still 50% away from breaking even. So if you're the type of person that doesn't have a long record of proven success avoiding drawdowns, then adding leverage is going to cost you. You'll feel like a rock star when the market's cooperating, but it will cost you more than you're ready to lose. And long term, for the vast majority of people, I'm going to just pluck a number out of thin air and say 95% of people are going to be worse off using leverage of any kind. Whether that's volatility ETFs, they should definitely be using the more watered down versions, not the UVXY, not the UVIX. And for equity indexes, if you don't have multiple years of proven success avoiding drawdowns, just asking for trouble. So again, I know it sounds incredibly arrogant when I say it, but I know what I'm doing. When I use leverage, I have already successfully navigated the market for, going on 18 years now. Not every time. We have drawdowns as well, obviously. I've had a bad year in the past, but yeah, I just leverage. So whenever I'm speaking publicly, I always said, don't use leverage. But I will say, like I said, full disclosure, back in the past, even though I never posted it, there was always kind of this layer that you could make substitutions. So you can see what we do now. I'm in the QLD. You can say if you have lower risk tolerance, they can use the Qs. For here, we use stock replacement. For here, if you have higher risk tolerance, you can use the SSO. I do say that here because we have always had the 2 portfolios. We've had the leveraged and the unleveraged. But I was always, up until maybe, I'm kind of taking a guess at this, but I'm going to say like 3.5, 4 years ago is when I started showing some of the leverage stuff in the email. But even for 8 years before that, we had both things. Like everybody in the community was fully aware that you could use the 2 times or the 1 times. I just did not feel ethically comfortable advertising any leverage whatsoever. So I was always very careful to say, don't use leverage, don't use the UVXY or the TVIX back then. But again, it's this sound, I can hear how bad it sounds when I say it out loud, but I know what I'm doing, so it's different for me. I know. Go ahead and light the comment section on fire, how bad that sounded. But yeah, I have a very, very long, successful track record of doing this. So do what I say, not what I do, something like that. Okay. On VIX Central, we should ignore the slight anomaly on October future. Yeah, I totally ignore it. I know it looks crazy and it throws off the metrics, but you got to remember that when you do the actual methodology of the volatility ETFs, it doesn't matter because it's using a constant maturity future. That's, the changing value of the ETF is how much that VX30 is going up or down. And in this case, the M4 to the M7, it also has that rolling future. So it doesn't matter if the M7 is super high right now, doesn't affect the volatility ETF at all. It just makes the data kind of look a little weird sometimes because obviously contango from M4 to M7 looks really big. That's why I always draw people's attention to the fact that don't just listen to people on Twitter who tell you to look at the contango level. The M1, M2, and M4, M7, while it might be pretty to look at and it might get you a few clicks and engagement on Twitter, that in itself means nothing. All that matters is the adjusted M1, M2 VIX futures when you adjust for the days to expiration in that cycle, or the VX30 to the VIX roll yield, how much those futures are actually above the VIX. This is what matters. The actual raw contango number means nothing, right? So M4 to M7 obviously looks crazy with this contango level because it's including this future, but in the end, that doesn't matter at all, right? Look at the M4 to M7 contango, 21%. If you look at my email, it's in the 90, where is it here? 99.8 percentile. Well, obviously it's not in the 99.8 percentile. That's why I said it makes some of the data look a little bit skewed, but I don't use these. This is just for information. We use these adjusted. We use the roll yield. We use good, solid metrics that actually mean something. So yeah, contango itself, meaningless. Adjusted contango, including the days to expiration, using the VX30 calculation, that's all that matters. Okay, let's wrap this up. That was our second live stream this week. So on your way out the door, please give me a thumbs up. Really helps the YouTube algorithm. And yeah, we will be back for sure next week. I am planning to try to do 1 per week at least. Maybe we can do 2 per week. So cool. Thanks, everybody. And we'll see you next week.